Good morning and welcome back to the latest edition of the InvestTalk market analysis for the week ending June 7th, 2024. I am host of InvestTalk, Justin Klein, and today I'm going to title the video Choppy Markets in Store Due to Muddled Economic Data. And we'll start with this chart, which is the CMA market expectations for Fed easing. And let's look at kind of what the change was from week to week. So 1 week ago, you had a 15% chance of no cuts by year end. Now it's only 13.7, and you have a little bit higher chance of 1 to 2 cuts. So it went from 39 to 40 on 1 cut, and from 33 to 35 on 2 cuts, and slightly less chance of more than that. So the market's starting to coalesce around that 1 to 2 cuts by year end, and a little bit higher chance of only 1 cut. And I could easily see it just be the November one, because and you're seeing that here, 47% chance of 1 cut by November, and in November. And you have the election coming up, and this Fed meeting is right after that election. So I could easily see them saying, "Oh, we don't want to cut rates until after the election," to make it not seem like we're doing anything to help one side or the other. But that's what the markets are saying. But let's dig into what economic data came in this week that's kind of solidified a more muddled economic picture. And that's ultimately why I titled the video that, is because you see some good and some bad. Construction spending month over month, that did tick down for 3 of the last 4 months now. So construction spending is certainly an important driver of the economy. Manufacturing new orders, that is staying relatively elevated, still up 1.29 year over year. So it's not shrinking, but it's kind of chopping sideways, kind of levels we've seen since mid 2022. The JOLTS data, that was probably the weakest number that you saw this week. Pretty big move down from 8.3 million job openings to just over 8 million. And, we're getting back to kind of pre-pandemic levels. That was around 7 million. So we're still elevated from there. And it just shows you a job market that, is not amazing. And the ADP number also came in on Wednesday. That was 152,000 jobs, the lowest number on the ADP front since January. So that's a more dour picture of the jobs market on those two numbers. And same with the ISM Service Employment Index. They did tick up a little bit from about 46 to 47, but which, remember, anything below 50 is shrinkage in jobs in the employment side, in the services side. And, services are 2/3 to 3/4 of the overall economy. So this is a very important number to look at. And so those three numbers say, okay, the jobs market is not doing so hot. You go to continuous claims, though, this isn't breaking out. This is staying kind of around the 1.8 million people that are on unemployment, and that's been pretty much the same since last fall, right? And then you get the non-farm payrolls here. That was 272,000 jobs. That definitely beat much higher than last month, and that was more of a positive. Now, we know there are some revisions typically, and I think there was a small revision down for the last 2 months, but overall, this was definitely a beat. Markets were expecting, kind of the high 100s to low 200s in jobs created, and it came in at 272. So that's a headline number, but I look at those all kind of in totality, and I still say we're in a labor market that is fine. It's not, unemployment rate ticked up a little bit to 4%, but it's not something that is a huge issue. It's just kind of mean reverting, and we're kind of in a steady state environment. Okay. Q1 productivity did come in only at 0.2. That is something to watch. Productivity gains are very important to earnings and economic growth, because you want the most out of your workers in an economy, and in the corporate sector. So the fact that Q1 was pretty weak, that's one-off. You can have these one-offs, right? You had negative 0.3 here. You had, during COVID, you had a string of pretty poor productivity numbers, and that was to be expected due to shutdowns and restrictions, things like that. So that was that was the market this week. Something to definitely consider. And that's why I'm expecting a more choppy market environment going forward. And I'll pull up this is the NYSE. This has been pretty much chop since the end of March. Right, we're actually down since the end of March on the NYSE. Remember, this is 2,500 different stocks. You look at small caps as well. That's the same since the end of March. You're talking about a down market. Now the S&P has been up, but not a whole lot, right? This is the end of March. You're at 52.50 or so. Now we're at 43.50. So you're talking about a 2% gain from there. The Nasdaq has been really the driver, obviously Nvidia, but you're starting to see, look at this roll on Friday. This is starting to lose momentum. Look at this MACD. Okay, this MACD made a divergent new high recently. This recent move is not something that is confirmed by many of the lower indicators. So you see this on the S&P as well. So I'm actually expecting a choppy environment here going forward. So don't get too caught up in chasing these new highs. Could we continue to go higher? Sure. But I am starting to become pretty neutral on the overall market. Now, you might say, well, we're going to roll over. Well, maybe, but there's not a lot of other indicators confirming that. You see that this is the short-term junk to short-term treasuries, and you can see this is still in an uptrend, right? You're getting some choppiness as you would expect, but this isn't breaking down. So the credit markets aren't having any issues or anything like that. And I think a big part of it is you're starting to price in a Fed pivot, right? You're seeing the 10-year start to drop. This is the 10-year Treasury bond ETF. So this is rising. It means that rates are dropping. You had a pretty decent rise in interest rates on Friday due to that good jobs number. But in general, the trend is now higher in bonds, and that means lower in interest rates. And the market is going to generally like that as well. I think a big question too was what's going to happen with the dollar. The dollar has been weakening over the past couple of months. Had a good day on Friday, but does this roll over? And if it does, that is also good for asset prices. So you're starting to see that more muddled picture that I talked about at the top. Is we had big gains in the markets as we headed into from the fall, right? That Fed pivot market came into the year expecting 6 rate cuts, and behind the scenes they've been providing a lot of liquidity. But you're starting to see going into Q3, the Treasury is going to issue more longer dated securities, and that's going to certainly weigh on sentiment, weigh on corporate balance sheets in general. You saw that back in Q3 of 2023, and that's why you saw that pullback starting in late July and into late October, and that's where the Fed pivoted, and then you had that move higher. And so, we've come a long way from that time, and the markets were overbought. Here's a weekly chart of the NYSE, and this is still solidly, the MACD solidly above the zero line. So the trend is still higher in the longer term, shall we say, medium to long term. But the short to medium term is starting to become a bit more muddled. You see that MACD rollover here. The blue line is below the red line. And that ultimately means we're likely to head into some sort of choppy period as we enter the summer. Remember, the summer is typically not a great time in markets. Not bad, but and October and September tend to be the worst months. September mainly. But a choppy June, July, August would not shock me at all. And then you maybe find some pivot in September or October as we head into the election. So that's kind of the general consensus of what I'm thinking is going to happen within markets. And I want to highlight this. This is there we go, growth to value trade. So this is going to be very interesting. I'll go to a weekly here. You're starting to get some hesitation. Last week, you had that big reversal. Growth definitely underperformed last week, but this week you had a little snapback. But until we get back above the previous week's high here, you could see a shift in markets. But a lot will depend on the dollar. If the dollar continues to move higher, that's going to be good for the growth side of the market. If the dollar rolls over, then that'll be better for the value side of the market. Now, I typically say the dollar will likely weaken, and mainly because of short-term rates. Because I do see this this is the SHY. So once again, this is going up. That means that short-term rates are dropping. So this looks to generally this is above the zero line here on the MACD. You're starting to see a trend change in bonds. And I actually think having a little bit of duration in this market is starting to become okay. Now, you don't want to lock yourself into 10, 20 year securities, but going out 3-4 years, I think is fine, because I think we are in a period where, and this is a little delayed, this is the 10-year, we're close to, I think, 4.5 now. But I think this is generally going to go into a choppy period. This is the weekly chart. Let's go to a monthly chart on the 10-year. Okay. Now we've broken out, but could we hang in the 3.5 to 4.5% range on the 10-year for a while? I think that's very possible, and I think we could be headed back down to 3.5 or so on the 10-year, as the Fed probably does pivot as we head into the back half of the year. Now let's get into some other charts. Let's go to the Move Index. That one did roll over on Friday, and that continues to not be an issue. The Treasury market is just fine. And this is telling you that. This is another reason why I think your rates are likely to kind of mellow out and come down here in the short term, because there's no Treasury dysfunction at the current time. Let's look at the commodity index. So commodities look like they were breaking out. You had a pullback, especially in oil, over the past couple of weeks. And the big question is, where will this head? The XLE did try to find a bottom here. That was on Tuesday. We'll see if this gets any traction to the upside. You're starting to see this go below the zero line. This needs to recapture the zero line in the MACD pretty soon. Otherwise, you could start to see kind of a weaker picture for oil in the short term. I still think by year end you resume an uptrend, but near term oil certainly needs some help getting off the mat. Let's just say that. Let's go to the gold chart. Here's GLD. And I think this is going through a consolidation period as well. We had that breakout in gold in the spring, and to see this, I think the GLD will stay between 203 and 225 for a little while, probably till the end of the summer before we get that next move higher. So I'm still a buyer on dips, but don't be shocked to see a little more near-term volatility for gold prices. And same with the GDX, right? That's going to likely chop sideways between what I expect to be. Let's pull this up here. All right, probably between this 3150 and 37. Okay, so and gold miners are pretty volatile, so no shocker there. What else do I want to get to? Let's look at some of the sectors. What's most interesting is utilities. Utilities are pulling back here, but with rates dropping and the higher demand for energy due to AI, I think utilities are a decent place to be in the medium term. So I kind of like that space. Industrials, that one is a bit weak in the near term, but I still like the longer term pattern. Pretty strong move off the lows in November. And if the economy reaccelerates in the back half of the year, which I actually expect it to, this should do fairly well. The VIX, this was up earlier in the week, but once again was beaten back down into the low teens here. So no real issue on the VIX front that's telling you that there's going to be major downside volatility. That's why I say this is probably more of a choppy environment that we're headed into, as opposed to something that's dire. Okay. Here's the banking index. I think that continues to be relatively weak. I'm not a huge fan of banks at the current time. Here's the financials. This is doing a bit better, but obviously you're lumping in the banks with the financials. So I think a lot of the non-bank financials are certainly a much better place to be. Here is, I think it's this one. There we go. Broker dealers. Here's the broker dealer index. I think that's a much better place to be if you are in financials, broker dealers. But these are the Goldman Sachs and Morgan Stanleys of the world. Sorry, there's Morgan Stanley. But generally, I think the financials are not a great place to be at the current time. I think it's higher regulatory costs, higher cost of capital in general, and certain subsectors, talking about private credit, office buildings, et cetera, that are likely to weigh on the financial sector in the near term, but not something that's going to create some widespread issue because those that are regulating that space are likely on top of any potential issues that could arise. So I wanted to highlight that you probably want to be underweight financials overall. Let's see, what else do I want to get to? I think that's about it for now. I think once again we're entering a choppy period, most likely in markets. A lot will depend on those. It's very top heavy. The breadth in the market is not very good. You can see that with Nvidia is obviously powering new highs, but the small caps are kind of just chopping sideways. And how long can kind of those bigger names in the markets hold up? Microsoft is losing momentum here. You see this; it's approaching the zero line, despite making still in a general uptrend. But this MACD is showing that is certainly waning. Apple has been strong as of late. That's one of the I think the strongest the FANG names near term. So Apple looks fine. Netflix also losing a bit of momentum here. You see this MACD divergence here, making new highs, but not getting new highs on the MACD. So watching for that. Meta as well. Meta not making new highs. Look at trying to hold that zero line on the MACD, also struggling there. So you're just seeing this across the board. Tesla, right? Tesla's been in a downtrend for a while. It's trying to get back above the zero line, but in general, it is below. Go to a weekly chart. It's below the zero line on the weekly chart, and this is in a protracted downtrend. So I don't see that one really getting off the mat anytime soon. And let's see, what are the other FANG names that I'm missing? Oh, Google. Yeah, Google's definitely the strongest here. Look at the weekly and then the daily. That just rolled over though, so we could see that one pull back. So I think we're set for some downside volatility in the near term, but that would probably launch us once again into a choppy period for markets. All right. So that about does it. I thank you all for tuning in and liking and subscribing to this video. Reminder, the contents of this video are for educational purposes only and should not be considered as a recommendation to buy or sell a security or to participate in investment strategy. The views are my own and do not represent those of KP Financial or those associated. Have a wonderful weekend.